All right, everyone, 7:03. I figured we should get started. I know a lot of you are excited, or maybe not excited, but at least very interested in what we have to talk about today, which is interest rates, inflation, recession. What is going on? There's lots of questions out there in the marketplace, and I want to go through a little bit about what's happened so far, why it happened, what to expect, and what you should be doing about it. Lots of questions in a market climate like this. So let's get started. First of all, welcome and thank you for joining. It looks like so far this is going to be one of our most attended webinars of the entire year. So thank you for joining us. I'm sure there's lots of questions about what happened, why it happened, what to expect, what you should be doing about it. So I'm going to break the PowerPoint into these 4 different segments and start to really dissect why we're in this situation today, and most importantly is really just coming to a conclusion about what you should be thinking about doing in order to protect yourself and get through this period of time. So let's get to it. First of all, obviously interest rates. Everyone wants to know what's happening with interest rates and frankly what has happened with interest rates. So let's pull back here. Let's look back perhaps 12 months and look at what's position and what situation we as a country and what the government was facing. So we had some inflation. It wasn't that high, but we did have some inflation. The Bank of Canada needs to figure out and determine what they're going to do about that. They have 2 different routes and paths they can take. They can either raise rates slowly. By doing this, they're going to risk inflation coming up and continuing to run away from them, but they reduce the risk of putting the country into a recession. The other option is to raise rates quickly and to combat the inflation and aggressively hit it head on. But by doing that, if you raise rates too quickly, too fast, you do risk a recession. And it looked like the timeline for a potential recessionary period would be 2023 to 2024. I think it's very clear and abundantly clear, I should say, that option is off the table. Bank of Canada has been raising rates very quickly to combat the inflation, and by doing so, are putting the entire country at risk of a recessionary period, which is almost completely baked into the marketplace now. So if we look at what has happened, I have a 5-year bond chart here, and the reason that I have a 5-year bond chart is that this is what determines 5-year fixed rates in Canada. Basically what happens is banks lend out money to people like you and I, and then they turn around and they bundle up bunches of mortgages together and they sell them out the back door. This act is actually called securitization, and these bundles of mortgages are called mortgage-backed securities. Now, the act of doing this is actually what caused the US subprime crisis back in 2008, because the US was packaging up bundles of mortgages that were full of junk mortgages, sprinkled in with a couple of AAA mortgages. And unfortunately, this act of bundling them up and selling them and eventually other people holding the bag was what caused the entire US subprime crisis, which eventually became the worldwide financial crisis in 2008. Now, the reason I'm explaining that is that if bond yields are moving up or down, that typically affects the mortgage rates, because as an investor, if I am a large company or country or individual looking at parking large sums of money, I can buy either a bond or I can buy a mortgage-backed security, or I can buy other similar asset classes. And so when you're an investor, you can, and certain asset classes are moving up or down, that means that generally the others also have to move. So if I'm trying to issue bonds and basically bundle up mortgages, sell them after I've already lent out the money, then if interest rates and bonds are starting to go up, then I need to offer a higher yield on my mortgage-backed securities in order to be able to sell them. So what ends up happening is, in general, if we're following the bond chart, and yes, this is my magic crystal ball, just following the bond chart is going to give me an indication of where interest rates are heading. If I take a 5-year bond yield and in general add about 1.5 to 1.8% onto that, then typically that's where fixed rate pricing is currently. Now, one thing I will say is that that is a general term of about 1.5 to 1.8. As of right now, it's actually a higher spread than that. We're closer to 1.8 to 2.2%, depending on the lending institution and the type of mortgage that you're taking. So those spreads can also change and be affected. But if you look at a current 5-year bond yield, which as of yesterday was 3.74, now believe it or not, this bond yield actually just plummeted and tumbled a little bit today, and it's actually closer to about 3.5 as of today. So yes, even just a presentation that I did as of yesterday is now out of date. Welcome to the the world of mortgage finance in 2022. But more importantly, what I wanted to express on this particular slide is what is impacting interest rates. So you can see at the far left here, I have COVID, and interest rates for bonds were very, very low, and same with mortgage rates. During that period of time, what ended up happening is the government was printing a lot of money. And when you hear about the government printing money, in general, what you need to understand is that usually in order to get money into the system, what they actually do is they buy bonds in the marketplace. And so, so they may literally just deposit funds into an account from somebody who's selling a bond, and all of a sudden the money shows up in their bank account, and now there's a bond that's off the market. And so what ends up happening is the government buys bonds. What ends up happening is if there's a major buyer in the marketplace, now all of a sudden it pushes the yields down. And so this is why we have very low interest rates. It's one of the methods that the central governments have in order to funnel money into the system during recessionary periods. And COVID was no slouch when it comes to that. And I'll get to how much money actually entered the markets and the system in a couple of slides. Now you can see a little bit of a tick up in a couple months into 2021. That was a $50 billion bond sell-off. So a large owner of bonds actually sold off a large package of bonds, about 50 billion, and that caused the rates to pop up a little bit. Then we had Omicron, so you can actually see that rates for a little bit of a period of time are actually slowly decreasing. That's because Omicron wave started to come up, and all of a sudden people are thinking, oh my gosh, we're not out of COVID yet. And then Omicron started to pass, rates start to climb up, and all of a sudden, oh my gosh, Ukraine, a war. So interest rates went down a little bit. And in many cases, wars often cause interest rates to go down. But in this case, what ended up happening is exacerbated existing supply chain issues. So all of a sudden, it was more difficult for European countries to obtain energy via oil and gas. A lot of exports around the world, or exports from Ukraine that travel around the world, like corn, wheat, potatoes, steel, iron ore, etc. A lot of those things all of a sudden weren't leaving the country. And so all of a sudden we saw that short term, it's a war, often interest rates decrease in times of war, but all of a sudden shot way up because it actually caused more inflationary pressures on a number of things. And then near the top here, and it's kind of encompassing the last 6 months, I would say, is something called quantitative tightening. And so what ends up happening is if the government wants to control inflation, what they end up doing is they start to sell off their bonds, and so they start to push and pull money back out of the system. And so they're actually reducing or maintaining the money supply by doing so. And so by doing this, if all of a sudden there's more sellers than buyers, it actually pushes the yields up instead of down. And so you may have heard of quantitative easing. Quantitative tightening is exactly the opposite, and that's what banks do, or central governments do, to unwind the effects of what they did during the recession. So fixed rates obviously have been on the rise throughout the year. Another thing that also has happened too is the Bank of Canada has raised rates at a total of 3%. Actually, it's now 3.5% as of this morning. And so these are the first increases that we've seen since 2018. If you look at the Bank of Canada, back in 2008 is when the last time that we had interest rates this high. So it's been quite a while. It's been 14 years since we've seen the Bank of Canada have interest rates at this level. Now you're seeing this 3.75% interest rate and wondering what that is, because it doesn't make a lot of sense. It's not the prime rate. It's not what fixed rates are going for right now. This is the overnight lending rate. So what happens is the central bank meets about every 6 weeks to determine if they're going to move the overnight lending rate up or down. In most cases, and you can see in this chart, most of the time they're very small increments. Most of the time these were only quarter-point increments, but you can see in some rare cases, like the subprime crisis of 2008 and into 2009, when COVID hit, there was massive decreases. But many times, usually on the way up, usually they're about quarter-point increments, and you can actually see here that in fact that was not the case. We've seen increments of half, 3/4, and yes, even 1%. during the last few months. And so the Bank of Canada is increasing rates and has been doing that for quite some time. So this is one of the largest increases that we've seen since the 80s. It's a major shock to the system, and one of the major concerns is just what's happening with the inflationary environment, not only in Canada but around the world. Now, the question is, how much does a rate hike impact you? So, from a dollar perspective, it might be less than you think, but the reality is that all of these little bits add up. And so, on a per quarter point increase per 100 grand, it's only $12 a month. The problem, however, is that most people, especially in British Columbia, don't have mortgages of $100,000 unless you're living in the boonies, or you've owned your property for a really long time, or maybe you won the lottery. But if you look at this, maybe you have an average mortgage size of $500,000 or $600,000. Let's call it 500,000. Every quarter point increase then per 100 grand is $60 a month. Now, the issue here is, of course, the Bank of Canada hasn't just been raising rates in quarter point increments. They've been raising rates at half a point increments or even full point increments. And so for anybody that had a $500,000 mortgage, as of this morning, your payment is going up by $120 per month, approximately. So these all add up. And of course, it's death by 1,000 cuts, because it's not like the Bank of Canada went up once and then that was it. They've risen a total of 3.5% over these last 8 months, which is quite substantial. So based on what we've seen so far, we've seen obviously bond markets have gone up, which is causing fixed rates to go up. We've seen the Bank of Canada increase the interest rates, which have seen anybody that's holding a variable rate mortgage has seen their rates go up. So what does the future hold for 2022 and into 2023? Well, let's talk about first, why all of this happened, and then we can start to make predictions about what's happening. So the obvious one here is oil and gas prices. The war in Ukraine has caused that, and we've seen inflationary pressure in oil and gas. Food is another major one, especially because Ukraine is a large exporter of food. I don't know who grocery shops. I know I do, but it seems like every time we go grocery shopping, the food just gets more and more expensive. And so when you look at the inflation numbers, there's a number of different things that are pooled into the inflation figures. However, some of the biggest buckets here are shelter costs and food costs and energy costs. And those are the main ones that have really been driven up. So I feel, and I'm observing that in a anecdotal basis, a lot of people are spending less money already. It's almost like we're in a recession right now. However, the problem is that supply chain issues and other issues have caused food prices to continue to climb even throughout this. Interest rates rising are not really necessarily making shelter costs less expensive. In fact, we still continue to this day to see inflationary pressures in many areas on rents, which is one of the major buckets and pools in what's called the CPI, which is the core inflation numbers. And so we do, however, at least see some light at the end of the tunnel. We can see that back in June, the inflation did peak at 8.1%. And since then, it has been decreasing. The last number that we have would be the September numbers, which was showing a 6.9% inflation. Again, just very anecdotally, I feel like we may see the October number decrease a little bit. But it's important to note that this number is way off of the baseline that the Bank of Canada is looking to set. They're typically looking for an inflationary number of 2% per year. That's their target. And most of their modeling of determining what should the interest rates be, how much money should they be printing in the money supply, and all these things is generally trying to target an inflation number of about 2% and economic growth of between 2 and 3%. Now, the problem here, of course, is that even back late last year, we saw inflation at about 4.7%, 4.8%. It seems, in hindsight, of course, that the Bank of Canada was a little bit late to actually start to transition into increasing interest rates. And I think that that's one of the reasons that we're in this position that we're in, is just that interest rates did not start to rise early enough and fast enough to combat the inflation. And that's a major concern. Why did inflation become such an issue? Well, here's a really interesting stat. The money supply is up 29% over the past 2 years. If you look at February of 2020, right before COVID, until February of 2022, or just a 24-month period, the total money supply in Canada went from $1.8 trillion to $2.35 trillion. That's up 29%. What that means is that each one of us has about 30% more cash in our jeans to go and spend somewhere. The money was pushed out in many different ways, including SEBA grants and all of these other grants during COVID. Well, that means that there's more money chasing less goods, right? That's a major issue. And not to mention on the supply chain issue, it's not even just chasing the same number of goods. That was actually chasing less goods because we had issues meeting the demand for purchases. We had a lot of issues, and one of the words that was used a lot by the government was transitory when they were referencing the supply chain issues. It's very evident now that the supply chain issues were not transitory. Transitory just effectively meant that they expected that the supply chain issues would eventually filter through the system and will be corrected. And to a certain extent, you would expect that to happen. Examples like the microchip shortage. The United States now has decided, okay, we're going to start to manufacture our own microchips. However, that decision took some time. It takes some time to build a factory, hire all those people. These types of things do not have an immediate impact on fixing the supply chain. So I think that the supply chain was less transitory than perhaps central governments were thinking. And so the problem is you have more money chasing not the same amount of goods pre-COVID, but less goods, and what is going to happen to prices? Now, on top of all of this, we are already seeing that prices were going up, and we already had inflationary pressures, and then the war in Ukraine hit, and now we even have more pressures because now gas prices, oil prices, gas and oil obviously is used heavily in wartime, especially because they need to move those tanks and planes around. Also, a lot of military goods and items are manufactured, and oil is one of those items that is needed in order to manufacture all of those. So major issues here, and all of these have combined to create a major inflationary problem. If you look at the amount of money that was printed in the last couple of years, here's an interesting chart that I found. You can see the green line is the actual growth of the money supply year over year. You can see that it has obviously increased significantly. And so this is a major issue if you're just looking at what are we looking at. We've seen a major bump up in the money supply, and it just means that more money is chasing less items, which is effectively what inflation is. So the question is, with all of this and what's going on, are interest rates going to go up or go down? And so I want to talk about what to expect with interest rates, because sure, it's important to know what's already happened, because it helps us to formulate an understanding of what to expect moving forward. Now, I want to pull up a chart here, and I'd like to go through this because this is very interesting. Because back in, and we've been, our office has been following this for quite some time, where there's some good data where you can find what the banks are all predicting is going to happen with interest rates, and then what actually has transpired, or what the current predictions are. And so I'd like to go through this and paint a bit of a picture for you, because it's interesting to go back, and I was actually a bit surprised myself when I was pulling up this data and how much this has changed. So back in May, this is what the major banks were predicting for the overnight lending rate. So just to paint a picture for you, add 2.2% onto all of these rates, that's the prime rate. So the overnight lending rate is 2.2% less than the prime rate. So that means that BMO, for instance, thought that the overnight lending rate would be 2.25 by the end of the year, and back in May, which would have represented a prime rate of 4.45. So looking at all the options here, the wide range was looking at a range of 4.2% to 4.7% for the prime rate by the end of this year. Now, fast forward to today, to what the major banks are thinking today. Wow, what a difference. Now we're looking at interest rates that are 1.5% to 2% higher than what they expected just 5 months ago, which is crazy. So now, for instance, BMO, an overnight lending rate of 4%, is representing them expecting the Bank of Canada to bump it up by another quarter point by the end of the year, which would put the prime rate from 5.95, where it is today, up to 6.2%. So looking at this chart here, we can see that most major banks are still predicting that the Bank of Canada will go up another 1/4 to 0.5% from where they are today, and that will be putting the prime rate up to either 6.2 to 6.45%. So that's the current expectation. I also want to look at back in May, what were the major banks expecting the Bank of Canada to be at by the end of next year? And so now we compare the first column to the third column. And if we go through this, we can see that using BMO as an example again, back in May, they expected the Bank of Canada to be at 2.25%, so that's 4.45% by the end of this year. And then they go up another 0.5%, so up to 4.7 by the end of next year. And so you can see in this chart that most of the banks predicted that the Bank of Canada would go up slightly into 2023 or be about flat into 2023. Now, I want to show this last one, which is the current predictions for what the Bank of Canada is likely to do by the end of 2023. So to give you a really high level of this, all of the numbers that are in black represent that the banks think that the number will be the same by the end of next year compared to the end of this year. So BMO, for instance, thinks that the overnight lending rate will still be 4% by the end of this year and also at the end of next year. However, if you look at this chart, there's three lenders or three banks in red that actually predict the Bank of Canada will start to drop as early as at the end of 2023 or even mid 2023, as some banks are predicting. Which I think is a bit early, but the general consensus here is that if you looked at the earlier expectations back in May, that they wouldn't go up as much during 2022, but then many of the banks thought they would still inch up a little bit more into 2023. Now the thought has changed a little bit where they're saying, you know what, the Bank of Canada has come up very hard and very aggressive on it, but now in order to combat a recessionary period happening in 2023 and into 2024, the Bank of Canada is likely to have to reduce interest rates. And that reduction can be anywhere from, in National Bank's case, they think it'll go 0.5% down next year. Scotiabank thinks they'll go down 0.25 point, and TD thinks they'll go down actually 1% by the end of next year from where they end up at the end of this year, which is very interesting. So TD's thinking that they go up as to quite a high level, and then just really aggressively start to decrease the rates into next year. So this is kind of painting a picture for what the current expectations are for variable rate borrowers this year. And so if we look at this, the expectation now is that we're going up another quarter to another 0.5% sometime this year, based on what the banks are all predicting. Now, if we look at bonds, because remember, bonds are what impact fixed rates. Let's take a look at where we were at in May. So most of the major banks were predicting that we'd be at about 2.6 to 3% for bond yields by the end of this year. Now, if you remember one of the first charts that I showed, the bond yields as of yesterday were 3.7%. Today, they're about 3.5. So they're hovering around that 3.5% range. So obviously much higher than what was predicted, anywhere from 0.5% to 0.9% higher than what the early predictions back in May were. Now, if we look at today's predictions, anywhere between 3.35% and 3.9%, on average, about the same as where we are today. So they're expecting that the bond rates and bond yields would be about the same as they are today at the end of the year. What that means is that if that is true, which remember, back in May, the same banks predicted and they were wrong, but if this prediction is true, then that means that we're likely at the top end of fixed rates, at least in the short term. Now, if I look at, again, column 1 and column 3 to look at the predictions of where banks thought that the interest rates would head, you can see that the items in black were that they'd be about the same. The item in the one rate that's in green there at 3.1%. Scotiabank thought that that the bond rates would go from 3% to 3.1 by the end of next year. And then RBC and TD actually thought that the bond rates would go down and would go down from 2.6 or 2.9 down by about 0.4 to 0.6% down to 2.2 or 2.3. So long story short, bit of a mixed bag as far as what the predictions were back in May. The major banks were looking at this and saying, yeah, the rates will probably be about the same. Maybe they'll drop a little bit. Maybe go up just a tad. Well, let's look at today's analysis. Every single major bank that puts these out is now expecting. So you're looking at column 2 to 4. Every single major bank is expecting that the bond yields will be lower by the end of next year than they are by the end of this year. So what that means is that we're looking at, if this is true, interest rates are more likely to decrease. If you look at in general, most banks are predicting it's about a 0.4 or 0.5% decrease in the bond yields, which in theory should decrease fixed rate mortgages down by about 0.4 or 0.5%. So based on this, it looks like if you were to take a 5-year fixed rate today, you may be taking a 5-year fixed rate at about the peak of interest rates. That's what it comes down to. Again, this is assuming that this information is true. And the people that put this together, the economists that work for all these banks, are much smarter than I. And so we generally like to rely on their data to help our clients make the best decision possible with the information that's available. Sometimes we're right, sometimes we're wrong. But based off of this, it's telling us and painting a picture for us that is saying, you know what, we think that interest rates may have reached their peak or are very, very close to it. So if I'm to get my crystal ball out and take a look at what we think is going to happen with interest rates, fixed rates, probably about flat, probably not going to be increasing much. And then the prime rate, either up or flat, anywhere from 0 to 0.5%. It looks like most of the major banks are predicting 0.2 to 0.5%. I was listening the other day to Benjamin Tell, who is CIBC's head economist, and he felt like the Bank of Canada was going to go up 0.5% in October, and then that would be it. So we'll see if that comes to fruition. I find it interesting that he would say that because CIBC, which is the bank that he represents, actually thought that they would go up another quarter point likely later this year. But in general, it looks like we're very close to the predicted top end. One of the interesting things that Benjamin Tell also mentioned is that in the US, the inflationary numbers are a bit more concerning down there. And on top of that, Canada on a per capita basis, and I'm always surprised when I hear this, but on a per capita basis, Canada is more debt burdened. So we actually have more debt per capita in Canada than they do down in the US. And one of the issues is that if the Bank of Canada continues to increase rates, it actually makes it harder for the government to service their own debt. And so there's a certain limitation to how high they can go. And Benjamin Tell was of the opinion that, and this is before the Bank of Canada increased the rates this morning, he did not expect that they would be able to push the rates up 1% higher than what they were before. So they've moved up 0.5%. He's of the opinion that that would be it, but he also thinks that the top end numbers that they probably can't go much higher than another 0.5% from where we are today. And so take that for what it is. Obviously, inflation is a major concern, and if this doesn't get under control, and if we see inflation numbers go up in October, heaven forbid, we may see that the Bank of Canada and the shift in the overall marketplace may change to say, okay, never mind, interest rates need to increase again. But there is a fine balance now. I think we're getting very close to that moment where the central bank doesn't want to teeter things over and put us into a major recession. They're trying to find that perfect balance of slowing down the economy, maybe a slight minor recession, but being able to recover fairly quickly and easily. Now, what this means for many of you is, what do I do with my mortgage? If you're getting a new mortgage rate, many major banks now are a 5-year fixed rate of about 5.79. Yes, 5.79%. Just crazy to see that number. It's been a long time since I've seen interest rates at 5.79. It's last time I saw rates that were around 6% was back in 2008, before the subprime crisis, back when rates were about 6 or 6.2. And on the flip side, it variable rates that as of this morning just increased. So they went from 5.45 for the prime rate up to 5.95. And so now most major banks are offering a discount of 0.3 off. That's about a 5.65% interest rate on a variable rate mortgage as of today. So again, you write things up for a presentation yesterday, and already 1 day later, the numbers have changed. So the question is, fixed versus variable. What do you do in this circumstance? Should you be going fixed? Should you be going variable? It's the thing that we've been talking about a lot. I had another colleague of mine who put it really eloquently, and he mentioned that in general, especially the last 30 years, variable rates have outperformed fixed rates in 19 out of 20 cases. And it looks like this might be one of those 1 out of 20 cases where, in hindsight, 12 months ago, we probably should have been going fixed. And of course, with the data that we had back then, it looked like the rates were going to go up, but not as drastically as they have. And so, of course, with hindsight, being 2020, of course, it would have made more sense in the past to go fixed. We can only deal with the information we have today. And looking forward, the question is, should you be going fixed or variable? Well, before we do that, just halt, because there's a new sheriff in town, and those are short-term fixed rates. And I will say that these are now the most commonly chosen terms with many of our clients, because short-term fixed rates, like a 1 year or 2 year or a 3 year fixed, are somewhere in this range. And so there's and when I put those 1 and 2 and 3 year fixed rates there, these are changing almost on the daily basis, and these are like the best rates in the marketplace, and that 1 or 2 lenders have those rates. But there's a couple of lenders that are offering really competitive short-term interest rates for 1, 2, or 3 year fixed. And the concept behind this is that, number one, the variable rate discounts are not as competitive as what we've seen in the past. Many of you that got a variable rate mortgage a year ago or 2 years ago were probably around prime minus 1%, give or take, which is a really good discount off of prime. And one of the reasons that we would have suggested at the time maybe to take a variable rate. Now, with variable rate discounts being much smaller or thinner, the idea here is that if you take a 1 or 2 or 3 year fixed, in particular, I'd say that for a while that the 1 or 2 years were common. Now I'd say the 2 and the 3 year are the more commonly chosen short-term rates. But if you take a short-term fixed rate, then in general, the expectation is that when that renewal comes up on the 2 year, 3 year fixed rate, that the rates are coming down or have come down by that moment. And you could either take a variable rate with a deeper discount at that time, or you could go into a fixed rate at a lower rate than what is available today. And so you're about the same. If you take a 2 year, 3 year, the rates are not much more competitive than a 5 year rate. But on the flip side, the idea is that you're about the same for the first 2 or 3 years. And then when your renewal comes up, ideally, you're able to shift into a lower interest rate. Now, one other thing I should be mentioning too is, especially on rental properties, for those of you that own or want to buy rental properties, we're observing that the money is starting to dry up, and there's a possibility that down payments might be going up. So in credit unions in particular, generally have only a certain pool of funds that they can use to lend out to investor clients and help them buy rental properties. We've seen a lot of those credit unions reduce the amount of rental income they use to help a borrower qualify. So in many cases, some of the credit unions were using 70, 80, 90% of the rental income to help the borrower qualify on a rental property, and they've now trimmed that amount down. And one credit union in particular was using 100% of the rental income for a while, then trimmed it down to 90, then to 75, and now they're at 50% of the rental income. And that's causing quite a challenge with them being able to place mortgages. In fact, I know some mobile specialists that work for that credit union that are struggling to be able to place any deals with them right now. So one of the issues is the money is starting to dry up, and it's just getting much harder to qualify for rental properties. Another issue too is that the government is putting a lot of pressure on all of the banks in Canada to change the methodology to reduce the amount of rental income used on the property that is being purchased or refinanced. So a lot of lenders have a reasonable calculation on all the rental properties that you own in your portfolio. They would call that an offset, for instance, and it just effectively means they use more rental income in that case. But the property itself, the one that you're financing, so purchasing or refinancing, they want to use what's called an add to income method, which effectively is using about half of the income, or sometimes even as low as a fourth of the income that an offset method would use. So effectively what the government is saying is, hey, we want to make it harder for borrowers to qualify for rental properties. The other issue that we've heard, and we may be seeing this come down the pipe sometime in Q1 or Q2 next year, there has been some talk about increasing the minimum down payment for rental properties. And just the other day, there was some interesting verbiage used by the government about the band of 75 to 80% financing. So anybody putting 20 or 25% down, and they changed the wording around a little bit. And I won't get too nerdy on you, but long story short, they changed the wording around in a way where it's implying that perhaps there might be some changes in the 75 to 80% financing range. So just to give some perspective on this, back about 15 years, when I was a young one in the business, they changed the minimum down payment to avoid CMHC from being 25% down to being 20% down. And many of you have forgotten that that used to be the minimum down payment to avoid CMHC. They changed it to 20% down about 15 years ago. And since then, we saw that a few lenders changed eventually and decreased the down payment for rental properties from 25% down to 20. I'm getting the sense that there may be an increase in the minimum down payment for rentals. And it might not be as drastic as we were initially thinking it might be, because we have seen other countries in the world increase the down payment for rentals up to as high as like 35% down or 40% down. But I think that we may be seeing some changes come in Q1 or Q2 of next year increasing the minimum down payment from 20 to 25% down on rental properties. So something to keep in the back of your mind, especially if you're looking at buying an investment property, because increasing the amount of down payment that you require has a large negative impact on your return on investment. If you go from having to put 20% down to 25% down, that's effectively increasing your down payment by 25%. It's a really big increase and reduces your overall return on your investment. So another issue that we're finding, and on the topic of qualifications here, is the stress test has also increased. And this affects every borrower, not just investors, but everybody. So for the longest time, the stress test was always just at 5.25%. So the stress test effectively was your rate plus 2% or 5.25%, whichever is higher. And so the banks wanted to make sure that if you're getting a mortgage 2 years ago for 1.69%, they wanted to make sure that if you come up for renewal and the rates are 4% or 5%, that you could still afford it to qualify you as if the rate was 5.25. Now, the problem is that now that the interest rates have risen, we've actually seen that that now that the rates are, let's say, 5.79%, we have to add 2% onto that in order to qualify you. So the stress test is based off of your interest rate and payments being 7.79%, which is massive. Frankly, I don't even think the government expects that in 5 years from now, if that mortgage comes up for renewal, that interest rates will be 7.79%. And this issue here is resulting in borrowing power being decreased by about 25%. So if you used to qualify for a mortgage of, let's say, $400,000, you're probably going to qualify for something about $300,000 now. So if you haven't gone through the pre-approval process to understand exactly what you qualified for, with every rate increase and every change, your borrowing power continues to get shrunk down and compressed. So something very interesting and very important for you to be following and watching. Now, I've heard a lot of talk about, oh, it's crazy, we shouldn't have a stress test at 7.79%. And to a certain extent, I do agree. I think that this rate is too high. I don't think that it's extremely reasonable that interest rates in 5 years would be 7.79%. So why are you stress testing and assuming that? But the reality is, all of this action the government is taking is to reduce inflation. And one of the ways to reduce inflation is to get people to stop buying stuff. That's really what the government is saying. Stop buying things, please, including real estate. Just stop buying stuff. And so the problem is, I don't see them in the short term anyways, doing something that would spur real estate again. I think that they actually want real estate values to drop. They want shelter costs to drop because that would result in decreasing inflation. And so although I don't think the stress test number is reasonable and fair, I really don't see it changing anytime soon. So one of the things that I wanted to look at here is what are all the factors and what's going on in the marketplace, and we can start to talk about how you should react to this. So we have rising interest rates, we have falling prices, we have tighter qualifications, we have variable rate trigger points and trigger rates. And so what ends up happening is if you had a variable rate mortgage which had a fixed payment, which meant that as the variable rates move up and down, your payment does not change. Well, what many people did not realize or understand quite fully, and frankly, this is probably the first time that we've ever seen this happen, because the last time interest rates increased this much back in the 80s, variable rate mortgages were not really much of a thing back then. But if you look at it, if you get to a point in a fixed payment on a variable rate mortgage, it's really the payment that stays the same. And so as the interest cost goes up, your amortization keeps getting stretched and stretched, and the amount of principal that you pay down continues to decrease and decrease. Now, eventually you get to a point where you're not even making the interest payments on the mortgage. And guess what? The banks don't want you to go into a reverse mortgage and into a negative mortgage. And so you eventually may hit a trigger point or a trigger rate. Now, what happens when you hit that is eventually the bank says, okay, there's a couple of different scenarios that need to happen. You have to make a lump sum on the mortgage, or you can lock it into a fixed rate, or you need to increase your payments on your variable rate in order to meet the terms of our agreements. And so a lot of people have been hitting this trigger point, which is resulting in them seeing a major jump up in their payments that they may or may not have been expecting. So it's really important to know that if you haven't hit this and you've been in a variable rate for 6 months, there's a good chance you may be hitting it soon. You need to be prepared for that. And we have prepared a write-up that we sent out to our database a number of months ago to explain what these trigger points and trigger rates mean, and what cost it might be to you. Now, with all of this, we of course have a looming recession coming up perhaps next year. And on top of that, a lot of investors are wondering, where do I put my money? Stock markets are tumbling, real estate values are dropping, interest rates are rising. I don't know what to do. It's caused a lot of questions. Have no fear. Green mortgage is here. What you should do about it is what I want to talk about, and that's probably the most important thing that I want to make sure we get into. There are some ways that you can help protect yourself and prepare yourself for what is already happening and also what is going to happen. And so let's break it down by category. And so I want to first talk about probably the most concerning group of people here, which would be people that are concerned about making your payments. So let's talk about this. The first point I want to make, and it's a very important point, it's going to suck for 12 or 18 months. There's no doubt about that. The conversations that we're having today, none of these options I'm going to give to you are a golden key. None of these are great. Locking into a fixed rate is not great. Restructuring your debts at perhaps higher interest rates, none of these options are fantastic. The key here is the government is asking everyone to spend less money. And I think in order to be able to control the inflation, we just need to do that. We need to hunker down, cut expenses, and ride it out. And the reality is it will probably suck for about 12 to 18 months. Now, if you're concerned about interest rates continuing to rise and being run away, because of course, we looked at what happened in May when the banks all had predictions, and look at us now. We're way above and beyond what those predictions have suggested. If you're worried about rising rates, and you're looking at where you're at now and where you could be if rates go up another 1 or 2%, it may be worth considering locking into a fix. But just know that rates are likely to come down in 12 to 18 months, maybe 24 months, depending on how things go. So if you're locking in general, we're recommending that you lock into a 2-year or 3-year fixed rate. And so talk to, you can get a quote from your existing lender. You can call us if we place the mortgage for you. Some lenders are offering much more attractive rates for short-term interest rates. And so it may even make sense to break your current contract and move it to another lender that's going to offer a more competitive short-term interest rate. So that's something for you to look into. If you're worried about interest rates rising, we do expect that it could be easily another 0.5% from the Bank of Canada in your variable rate, then you might want to consider locking in some of your variable rate mortgages into fixed rate mortgages just to weather this storm. Another option is to switch your mortgage into a HELOC, a home equity line of credit, which have interest only payments. Now, I don't like this option in some cases because the reality is a line of credit is typically priced at a higher interest rate. So most banks price the line of credit at prime plus 0.5%. So as of today, that'd be a rate of 6.45. Many of you probably have a mortgage. If it is a variable rate, it might be prime minus 0.5 or even better than that. So there's a 1% gap between a home equity line of credit pricing and a mortgage pricing. And so I don't like the idea of our borrowers paying more in interest cost. But if you're very concerned about payments, and that is the most important thing to you, and you may be forced into selling the property or doing something else in a bad market, well, it might be worth doing something a bit more drastic, like moving and shifting the entire mortgage into a line of credit just to get interest-only payments. And this could be something that helps protect you from being in a situation where you can't afford your mortgage payments. So just note that the home equity line of credit percentage, it can't be more than 65% of the value of the home. So if your home is worth $1 million, you cannot get a line of credit for more than $650,000. So something to keep in mind. Now, here's an option that is not discussed a whole lot, and I'd like to shed some light on it. If you're over 55 years old, you may qualify for a reverse mortgage. Now, what's the difference between a mortgage and a reverse mortgage? A mortgage typically is amortized, and that means that you're paying down principal and interest, which means you're slowly paying down the mortgage over time. What happens in a reverse mortgage is you do not make payments on it. So what happens to the interest? It gets added to the outstanding principal. So your mortgage actually goes up over time. So what ends up happening is the way that they underwrite these files is they look at your age, the value of the home, where it's located, and the reality is that they're looking at how much risk do we have to give this person a reverse mortgage where the value will continue to increase year over year. The reason that you have to be 55 plus typically to qualify for these reverse mortgages is because they look at the expected lifespan of individuals, and they look at, okay, so the expected lifespan is this, then the expected amount of that the loan will increase over that lifespan is this amount. versus the expected appreciation, and we expect that that we probably will not lose money on this loan, is effectively how they look at it. So the really nice thing is that there are no payments on this. We've had some conversations with people where there are parents that are wanting to help out their kids during this tough time, and in some cases they're getting a reverse mortgage on their home to do a early inheritance payment to their children, just to help them with their current financial situation, either with as a gift to help them buy a property, or just to help the kids reduce their debt load now that the costs have gone up significantly. And it doesn't cost the parents anything, and it's just basically an early inheritance, because they're saying, hey, you're going to get this money at some point in the future. Why don't I just give it to you now, because it seems like you need it now more than you need it later. And yes, it will erode the equity in the home over time, but that's something that that some people are looking at just to get through this next 12 or 18 months. And another thing that I want to talk about is the Manulife One. A Manulife One is effectively a line of credit, and the cool thing about the line of credit is that it can act like a reverse mortgage. And so if you have, let's say, an outstanding balance of $300,000, but you get a limit of $400,000 in total, you can actually use the Manulife One as a reverse mortgage, where you don't have to make a payment on the line of credit, and it can capitalize itself just like a reverse mortgage. So as long as you have enough credit limit, then you can let the payments continue to add on. And so if you're in a really tough spot where you can't afford payments, or you really need to afford interest-only payments, or you just need to be in a product where you just can make whatever you can pay each month, then a Manulife One product, which mortgage brokers have access to, could be a really good tool to look at. Another option is just to get a line of credit added to your mortgage to give you a bit of a buffer, and you can use that in tough times, because it's really important for you not to get into deep credit card debts or other debts here in the next little while. Or if you're really in a tough spot and you can't qualify for a line of credit, and you're starting to get a little bit higher in the debt load, then you may want to look at getting a second mortgage on your property. Now, a second mortgage is not cheap. I'm not going to sugarcoat it. A second mortgage is going to be in the double digits. But what's really important, and the analogy I usually use, is that it's like putting a Band-Aid on the wound to allow it to heal properly. Do not let the wound fester. If you're in a situation where you're maybe going to be missing mortgage payments or credit card payments, or you're getting really close to your available limit on your credit cards, you don't want to be putting yourself in a position where, let's say that your mortgage comes up for renewal in the year, your renewal comes up, you've got all this credit card debt, and you can't qualify to refinance and bundle that all up into one mortgage. Ideally, what you want to be able to do is, yes, maybe the second mortgage is slightly higher interest, but really, if you look at the credit cards, et cetera, it's probably about the same overall to pay off all your credit cards and all of your other debts. Lump it all into the second mortgage. Then you're not having any issues with the credit, and you'll be nice and clean, so that when your renewal comes up in, let's say, a year from now, and the interest rates maybe are starting to come down, maybe it's 2 years, who knows, but eventually the interest rates come down and the qualifying rate comes down, and you're able to just wrap up the first and the second mortgage into one bundle again, and you're back to A lending again. So it's really important for you to be in that position, because we've seen it before. People say, oh, it's just too expensive, I don't want to do it. And then a year passes, and then the situation gets worse and more dire, and they have more credit, and now their credit rating keeps taking a dive to the point where they can't qualify with major banks anymore. And now it gets more and more expensive for them. So it's really important, if you're getting put into a tough position, then just make sure that you understand that a second mortgage, even if it has a bit of a cost, can save you money in the medium term and the long term, because at least you'll be very good to go when you can qualify again to refinance. The last thing I want to add on this list here too is that if you're in a situation where if you're on a really short amortization, you can ask your existing lender to re-amortize your mortgage, and if they won't do it, then you can talk to us or another lender or another broker about re-amortizing your mortgage with a different lender. So if you're with a bank and you're at 15-year amortization, your bank may allow you to extend that out to 25 or even 30 years without you having to re-qualify. So that's something that you may want to explore if you're having issues with making your payments. And if your bank won't do that, then you may need to look at alternative options and perhaps refinance the property to move it somewhere else. Now, another situation, let's say that you're carrying a lot of debt and it's starting to burden you. You need to refinance, and you need to refinance sooner rather than later. That's the reality of the situation. You can't be carrying debts and credit cards and other debts on your credit bureau. It's going to negatively impact your ability to service all of this debt. And as I mentioned earlier, your credit rating is taking a tumble. So one of the things that we look at here is we've built a consolidation analysis. So fancy word for refinance calculator, where we can look at your current mortgage, your current interest rate, what your estimated penalty would be to break that mortgage, and we can look at what the savings would be to redo the mortgage at current interest rates and into a new term and amortization. We can also look at, well, what happens if we pay off all of your debts? And I will say this, even if you have a low interest rate already in your mortgage, in general, it would not make sense for you to pay a penalty to break a mortgage that has a lower interest rate today, and then also be taking a new higher interest rate mortgage. And you're basically getting hit on the penalty and on the upcoming interest. However, there is an exception. If you're carrying a lot of debt, and this is where we can use the calculator to review this for you. If you're carrying a lot of debt, then these are really, really important reasons to be looking at breaking your mortgage early, refinancing and bundling all of that debt up into the mortgage, because I can tell you that the more debt you're carrying, the more likely it is that it makes sense to refinance, even if your current rate is much lower than current market rates. When we do this analysis, we can compare it. We can look at the remainder of your term. So if you have 3 years left in the mortgage, we look at that. We can also, the spreadsheet allows us to put in expectations on where interest rates will be in the future as well. So it allows us to take a look at not only the next couple of years remaining in your current term, but also what happens over the next 5 years. So we can do a really good comparison. The cool thing too is we can also use the spreadsheet to build in expectations on what may happen with the Bank of Canada. And we've been using the spreadsheet to help our clients decide whether they should be going with a fixed rate mortgage or a variable rate mortgage. Because yes, variable rate mortgages in the next few months are likely to go up. But if what the banks are predicting is true, then eventually in 12, 18, or 24 months, the rates are going to start coming down again. And if that's the case, then you might actually find that taking a variable rate mortgage, if that happens, would actually result in a lower amount of interest paid over the term of the mortgage. So just something that we've created, a nice tool that makes it a little bit easier to make some decisions when just figuring out, should I refinance or not? If you can't qualify, if you're struggling and you're fighting and you're realizing that, oh my gosh, I can't approve for a loan, we do have some solutions for that too. We have a couple of lenders that allow for higher debt servicing programs. Most lenders only allow you to use 44% of your income to qualify. Some lenders will allow you to use up to 70% of your income to qualify in certain cases. So this is something that's really important to look at. Just know that different lenders have very different products. Like net worth products, for instance, where some lenders, if you have a certain amount of net worth, most lenders require $250,000 minimum. Some lenders are as low as $150,000. But effectively, if your income only qualifies you for about a $500,000 mortgage, some lenders will say, well, you've got 300 grand in eligible assets over here. We'll add that $300,000 onto the 500 grand of mortgage amount that you could qualify with your income. And now you can qualify for up to an $800,000 mortgage. So I'm obviously simplifying things, as every lender has a slightly different net worth program, but the easiest way to explain is that many lenders have a program just like that, where they take the eligible amount of liquid assets and add it to your borrowing power to determine how much you qualify for. There are some programs for self-employed borrowers too. There are some programs where if you're incorporated, they can look at how much income the incorporation made that you did not take home personally and add that to your income as if it was take-home income. So if you're self-employed and you're finding that your bank can't qualify or your current agent can't qualify you, there may be other opportunities with other lenders under some of these programs. And these are more complicated. They're very difficult, but our team is very adept at being able to assess these and read the financial statements, and frankly, to then sell it to the lender to get those deals done. Reverse mortgages. So as I mentioned earlier, reverse mortgages don't qualify based on income. They actually look at the property and your age and how much you're looking for, and that's about it. And so a reverse mortgage is something where there's no income needed. So if there's a major issue with the amount of income and you're 55 plus, or if you're trying to look at helping a family member who is, a reverse mortgage might be a good option. There's also B lending. B lending is, of course, more expensive, but there's way more solutions. They allow for higher debt servicing ratios. They have better self-employed programs. So there's a lot more flexibility on the B lender side. And then private lenders, where they really don't look at the income a whole lot. So some of the private lenders don't even look at income at all. They just like, what is the property? Where is it? And how much are we lending on it? And what is the exit strategy? And that's really it for determining whether they're going to lend to you or not. So private lending is a lot easier, but obviously out of all these options is probably one of the most expensive options. Now, in going through this, just remember that every lender is different and many have changed policies. And the key that I wanted to highlight here is that we've seen this, and years ago, banking used to be relationship style banking. You go into the bank, your banker would say, "Hey, I know you, you know me, I know you're good for the money, handshake, here's the loan, everything's great." The reality is that the game has changed as more of a transactional style banking. And in fact, there's been a lot of audits since 2018 where the banks are required to fit their box. And the problem is that many boxes had to get adjusted or changed, and every lender now has their own little box. You may, regardless of what your relationship with your bank is, you may not be a fit for their box, and you may not be a fit for them anymore. Even if they like you as a customer, you might need to go outside of that box and go to different lenders in order to be able to qualify. So that's something you need to be aware of, and something that a mortgage broker can definitely help with. Another point I want to make here is shopping your renewal. So when your renewal comes in the mail or the lender contacts you, you have the option of signing a piece of paper saying, "Yep, I'll take this term," and you're good, and you're done. And the reality is, in many cases, that is what makes a lot of sense for you. But one of the things we've observed is in the last little while, there's a bit more of a divergence between different lenders, different rates, and different offerings. Some banks are really competitive on 1, 2, and 3 year fixed terms, and some are not. And in most cases, usually the rates are pretty similar, especially for like 5-year terms. A lot of the banks are very similar, but there's a really big gap between 1, 2, and 3 year rates with many of the lenders. And some lenders have really good rate specials right now, and some lenders do not. And so all we're saying is, now that interest rates have risen, is more important than ever to make sure that you're shopping your renewal rounds to figure out who is the best rate for you, so you can ensure that you're getting the lowest possible cost in your renewal and getting, frankly, the right advice. Now, all of these things, we've talked about people that are maybe in rougher shape. But what if you're in good shape, like this guy, or like me? That was a joke. I'm not in great shape like this guy. But what if you're in good shape? One of the things that we've been telling a lot of our clients is considering utilizing your equity and maybe not pulling the trigger on something right away, but having your equity available to be able to pull the trigger. Because a market like this has a lot of opportunity. There are going to be some people that have to sell their home because they have a buy on the other side. There's going to be some people that have a pre-sale that they can't qualify to close on, and they have to dump that pre-sale and just ideally get their money back, or even just get rid of the contract. There's a lot of situations that are going to come up because of this, and these opportunities are where people can make a lot of money and take a major step ahead with their net worth. And one of the things we recommend is that a home paid off is not really working for you. You're not really making much money other than just the appreciation on the home. And so we're often telling our clients, look, if you don't already have one, get a line of credit on your home, because there might be an opportunity that's too good to pass up. And what I'm finding right now, and a couple of deals that have come into our office lately, are very quick closes. So there are buyers of ours that are able to close very quickly with a seller to give them what they're looking for on terms. But guess what? Our buyer is getting a really good price because they've offered really good terms in other ways. And so one of the things to be able to do that and to be able to close quickly, you have a line of credit where you can just write a check and buy something cash without needing to go through a mortgage process. You can write a check, buy it with cash, take it off that seller's hands, and then refinance it after closing and get a regular mortgage on it later. So we're advising a lot of our clients, if you're wanting to be ready to take advantage of opportunities in this market, getting a line of credit on your home is usually this step number one. So making sure that you're just ready to take action in a tough time. Another thing is really important, evaluate your investments. A lot of people have seen that the stocks have tumbled and they're not really sure what to do. There are a lot of opportunities in the marketplace, and it's just a good time to reevaluate, where you're investing. I do have a lot of clients that are now looking at maybe they don't want to buy real estate because they're not sure about the values, but they're interested in being a private lender or investing in a mix. So a private lender means that it's an individual that would lend to a borrower that can't qualify for a mortgage. And in general, those rates are anywhere from 8 to 12% or even higher than 12%, depending on the type of situation. You can also invest in a MIC, which is a mortgage investment corporation, and that's a pool of funds. And so you're not the one person that lent to this one borrower. Instead, you're giving your money to a pool or a fund that has $200 million in it. And so even if one borrower goes belly up, it's a very small percentage of the overall pool or fund. So anybody that wants to learn more about MICs or private lending, you can reach out to us and we can get you in touch with somebody that can talk to you more about that. And then, of course, getting pre-approved to take advantage in this market. I can't guarantee that there will be opportunities that will come up, but I've seen this type of market a few times in my career. And the people that are active and ready and waiting and sitting on the sidelines and ready to pounce on an opportunity are the ones that can do very, very well. There's going to be a certain number of sellers that have to sell. And if there's a limited pool of buyers and you're one of them, then that's an advantage and an opportunity for you. So yes, it is a pain in the butt to get pre-approved. Totally get that. We're in the same boat. A lot of paperwork to do that. But if you're ready and an opportunity comes, if you're not pre-approved already, it's going to be really hard for you to pounce on that and move quickly. We highly recommend that if you're wanting to keep your eyes open in this market, you should get pre-approved ahead of time. Now, one thing that we did do is we have made it easier to get pre-approved because we've created this spreadsheet. And I know it's just a spreadsheet, but I've spent probably over 100 hours making it and perfecting it. But basically, it allows our clients to put in their property portfolio, put in the details of their existing portfolio, and provide us just with their 2 years of tax returns. And what it does is it actually generates results for us. So it tells us what their debt servicing ratios are. It allows us to actually look at all of the different lenders and determine which properties are underperforming and overperforming based on that. Because sometimes we look at it and say, look, this is the worst performer according to the lenders. If you just sold this one property, then you could qualify. It highlights a number of things for us. So it actually speeds things up because frankly, going through a mortgage process is a lot of work for you and also for us. And so this allows us with minimal documentation to give you an idea of whether you'd be able to qualify. So especially you in the audience here that are investors who have a couple of properties, you know how difficult it is to get a mortgage and also how much paperwork and pain there is in getting it. This is a tool that we've created and produced to make that easier for both parties to just get a ballpark of which lenders you'd be able to qualify for and how much you might be able to qualify for with them. So if you're an investor, what our investors are doing right now is they're increasing their home equity lines of credit. They're parking money into short-term investments like private lending or mix, or even in some cases, hey, other than just sitting in cash, maybe just park it into a redeemable GIC. You know, at least you're going to get 3.5% or something on that money, right? So just do something with the money. It's important to do something instead of just sitting on cash. Getting pre-approved to take advantage of opportunities, and then either riding at the variable rate for the next little bit or considering taking a short-term fixed rate. Those are kind of the two things that we're finding most of our investor clients in particular are doing right now. So we've gone over a lot of things today. I'm sure that a lot of you have questions. If you do have any questions that is not that we cannot answer tonight, then you can definitely book a consultation with one of our team. I am a best-selling author, so myself and a friend Jesse, we wrote a book called Rockstar Real Estate Investing, and it actually became an Amazon best-selling book. So it talks all about the fundamentals of investing in real estate. Anybody would want a copy of that book, please email us at info@greenmortgageteam.ca and put in your mailing address, and we'd be happy to send you a copy of our book. And you can read that, and it'll give you fundamental information and just a baseline knowledge of how to invest in real estate and what to do. And other than that, if you have any questions, email us at info@greenmortgageteam.ca, visit our website at greenmortgageteam.ca. You can also call us at 604-229-5515. And now that I'm finished, I'll open up for Q&A, as I know there's some questions in the Q&A. And then once I've gone through the questions in the Q&A, I'll just check the chat too to see if there's any questions there. So I have a question here. Is the potential increase in rental down payment going to lead to a bunch of people buying owner-occupied properties 5% down and then converting to a rental a year later and repeat? How do you think they will plug that hole? Interesting question. So it is a strategy actually for many people to buy a property that they're going to live in for a year or 2 years or whatever, but buying a property that today serves their personal needs, but eventually will become a rental property later on down the road. And so I don't think they'll actually close this loophole. It's already very difficult to qualify for a number of properties. And in general, I don't find this strategy works past about maximum 3 properties total. So if you bought a residence 5% down, and then you bought a new residence 5% down and turned in the current one into a rental, that's a common strategy. But then doing that one more time, it becomes a very large burden on what's called your debt service ratio. Just carrying all those mortgages at such high amounts on 25-year amortizations, that's the maximum amortization you can get with less than 20% down, and you're financing with the 5% down, and then also the CMHC premium is 4%. You're effectively financing 99% of the property values. that's a lot of debt to be carrying, and it's really hard to be cash flow positive. So it is very difficult for you to acquire a lot of properties that way. And in general, the insurers eventually say, you can't own that many properties. They don't usually want you to be owning more than about 2 to maybe 3 with 5% down in total. I have a question from Mark. So does the Manulife one still not report show in your credit report? I know that for a while there, it was not showing up on the credit report. I believe that they are at this time. However, occasionally, sometimes a loan will not show up on a credit report. Hard to say, but in general, I would never get into a loan or a mortgage with the expectation that it will not report in your credit bureau, because sometimes you've had it before. And I remember doing a deal with one bank. We send over 5 loans to them, all in a company name, and the borrowers were personally guaranteeing it. And for some reason, 4 of them did not report on the credit bureau and 1 did. I remember the borrower came back and said, hey, this one mortgage is reporting the credit bureau. And the banker said, well, you can either look at it and say, well, one of them's reporting and that's really upsetting, or you can say, well, 4 of them are not, which is a good situation, I suppose, in that case. So something to consider and look at, but I would never recommend that somebody tries to get a mortgage specifically looking at which lenders are going to report in the credit bureau and which ones are not. We have a question about the CPI inflation is almost even since 5 months. The CPI could be low by April or May. So yeah, it's an interesting thing to look at. So CPI is the core the core inflation number, and there's a number of things that are included and excluded in the core inflation. But the reality is, I think that we're all kind of noticing that that the inflation numbers are starting to slow. So it'd be interesting to see. But if the inflation numbers slow drastically, then hopefully the Bank of Canada will put a stop and put a halt to all the rate increases and stop the madness. But I'm not going to be too optimistic. I think I may have been more optimistic earlier in the year, especially based on what the banks were all predicting, and that was evidently wrong. So we're just trying to make sure that our clients are expecting the worst and hoping for the best. Here's an interesting question. So what are you telling your clients when they call and are very emotional, even crying about the payment increases? How do you and your team handle this? Great question. It is a very emotional situation, and people are in a really tough bind right now, and it's really unfortunate. It's an emotional thing. I think that the first thing that we try to do is obviously console the client and really start to dive into it and offer to help in any way that we can. I think that the reality is, people need to understand that we are in an environment where there's a lot of free money getting handed around, and they probably received some of it. A lot of other people received a lot of free money, and that does not come for free. Somebody has to pay the piper, as they say, right? And so I think it's really unfortunate that some people were put into situations like that. We've had some calls like that too. A lot of our clients in particular are real estate investors, and so less of them have a major concern about increases to the interest rates because they may have other, more capital somewhere else or whatnot. But in particular, yes, I'd say the first-time home buyers are in a tough spot. So the first thing I think is to emotionally console the individual, and in general, try to get right into solutions. And I think that one of the things that we really tell people is, look, it's going to suck for another 12 to 18 months. The sooner that you adjust your finances to adjust for this, the better. I think one of the interesting observations I've had, if you took a variable rate a year or two ago at prime -1, and the variable rate is at 5.95% right now, you're actually at about a 4.95% interest rate. Now, to put that in perspective, when you obtained that mortgage, you qualified as if the payments were 5.25. So even at the current variable rate right now, your actual payment and actual interest rate is likely less or about the same, maybe, as what you qualified at when you obtained that mortgage a year or two ago. So it's an interesting observation. I think one of the problems, and it's important for all mortgage brokers and bankers to do this as well as possible, is to make sure that it's framed in a way where you say, look, here's your current interest rate and your current payment, but you're qualifying as if the rate is 5.25. You should be trying to set aside a certain amount of money per month to set up in a TFSA or some other type of investment to make sure that if the rates do go up, you can still afford your payments. And so it is interesting. And one of the things I I remember really understanding after reading a couple of books is the concept of price anchoring. And I think the same thing applies here. Even if you qualify to 5.25, the borrower never sees that number. They often just see what their actual mortgage payment is when the mortgage started. But then they get anchored and they budget, their budget gets anchored to that low payment. And what happens is when payments go up, they say, oh, I can't afford this. It's like, well, you did qualify as if the rate was much higher in the beginning to actually be able to afford this. But because you set your budget way at the floor without preparation of saying maybe you should save extra money, you should do this or do that, I think that that all of a sudden anything above that very, very low interest rate is now too high. And the reality is, I think that you have to be fairly, I'm not going to say stern because that's the wrong word, but I think you just have to be really real with your client and say, interest rates are going to, or have already risen. They're going to rise a little bit more. This is, at least you know what to expect. And it's going to be tough for 12 to 18 months. You need to cut back on expenses and get through this. And I'm sure that you'll get through it. I have a question from Ron. The liquidity in the fixed income market is starting to seize with the Bank of England a few weeks ago. So we may see a peak and pivot in rates by mid next year. Just my thoughts here. Yeah, so what Ron is mentioning is all of a sudden, and for you, those of you that are nerds, and there might be a couple here in the audience because I still see there's quite a few participants in the Zoom. For those of you that are finance nerds, a few weeks ago, the Bank of Canada all of a sudden, or Bank of England, I should say, had a short-term liquidity crisis. And what ended up happening is all of a sudden, even though the many central banks are actually pulling out, and that's the quantitative tightening that I was mentioning, where they're actually selling off bonds to force interest rates up. All of a sudden, when they were doing that, there's a lack of liquidity. And in a lack of liquidity, all of a sudden, those bond markets started to rise up very, very, very aggressively. And so this was a major issue and a major concern for a short period of time. What ended up happening is the Bank of England actually reversed things. And even though they want interest rates to rise, they actually had to reverse and actually started to buy back bonds and push more money back into the market just to stabilize things for a short period of time. So interesting observation, Ron. I do think, however, that the central banks are just going to balance things out. And instead of just being a pure seller, for instance, or pure net seller, they might be a buyer and a seller for short periods of time. But I think over the long run, I still think that they're in a quantitative tightening environment where they're trying to balance out their balance sheet. I was looking at the overall money supply in Canada, and since February, the overall money supply is about the same. And so you might see 1 month where it goes up or down, but in general, I think that central banks are trying to keep the money supply at about the same number, give or take, which is effectively is causing slight tightening there. Just a note, so glad I saw this on the Facebook page. Thanks for a great presentation. No problem. Thanks for joining. And then the name of the book that you can get is Rockstar Real Estate Investing. And if you email us at info@greenmortgageteam.ca then and put in your mailing address, we'd be happy to put a copy of that in our in the mail for you. Okay, awesome. I'm going to take a look at the comments as well, just to see if there's any notes or comments in there. Yeah, so Farun, I'm reading some of your notes here. Very interesting on a couple of items. So I didn't get into this because I frankly, this webinar has already been almost an hour and a half, so it's been a long one. But one of the things that that we want to look at here is what happens if all of a sudden, so as a developer, you're seeing that your costs have risen 20 to 30%, and at the same time, too, demand has fallen. And so for you to sell and launch a new development project, all of a sudden you're finding that you're getting squeezed. Your costs have risen, and in order to sell your product, you have to drop your price. It's putting us in a really awkward position here, because now all of a sudden, if there's fewer properties being built, and that's either for condos for future resale or purpose-built rental properties, because interest rates have risen and prices have not really fallen, and especially costs, which means it's harder to justify building a rental property building. We're going to have a supply problem in the next couple of years, absolutely. And so it's interesting because what we're telling a lot of our clients is just hang on for as long as you can, because we feel like fast forward 2 to 3 years, values are going to go up again for sure. Almost certainly. I would put a lot of money on that, especially in major urban centers, especially condos, because based off of what we're seeing, affordability, that's where affordability is in the condos right now. Net migration, migrants typically go to major urban centers, and they're often very used to living in close quarters, depending where they're coming from. And so condo living is perfectly normal. But in addition to this, I don't think that we're going to see as many units being built, because a lot of developers that I've been talking to are just putting a pause on their projects. And so what ends up happening is we'll have less new housing starts, and fast forward a year, 2 or 3 years, really probably 2 or 3 years, because most, especially towers, take 3 to 4 years to build. We're going to start to see a supply shortage. And what happens when you have low supply and as demand starts to tick up because interest rates go down again? We're going to have the same issue. And again, the government is not doing a good enough job of attacking the supply problems that we have in the marketplace. That is an issue. It always has been an issue, and I'm not sure when we're going to see this getting solved. So it'll be interesting to see what happens with the supply in general. But yes, that's going to be an issue moving forward for sure. I had a couple of other things that I saw in the chat. Let me just pull that up. Let's see here. Let's see here. Oh, Patricia was mentioning, I think that's about the rental properties and increasing down payments. So yes, I think the issue with increasing down payments for investors, I think that their concern is that investors can invest in many different asset classes. And if the down payment percentage is only 20% down, it improves their return on investment, which then means that a lot of people funnel their money into real estate investments. If you increase the down payment, then you're going to have more people funnel their money perhaps into stocks or other investment classes, which don't push up real estate prices as much, and provide more money towards stocks, which in turn give companies more money to use to grow. And so it's an interesting concern and issue here. And as Farun mentioned, it is a bit of a double-edged sword, because if it doesn't make as much sense to build and own rental properties, then there'll be less, which means the rent rates will go up. So it's a very interesting observation. Yeah. Let's see here. I'm just going to see if there's any other questions that I haven't addressed here. Daryl has a question. Is there any change in credit for short-term rental income, so STR income? No. So interestingly, down in the US, I know that there are a couple of programs that will literally go to a website, and a website like AirDNA, for instance, they'll take the average daily rent and determine what the expected rental income for that property would be. And then they use effectively a commercial style underwriting policy. So they'll say, okay, as long as the property produces, in addition to all of its expenses, an extra 20% in income over and above all of the expenses, then we'll lend to you. And they reverse engineer the maximum loan amount based on that. That hasn't really happened here. There are some lenders that, after you have a couple of years of tax returns, can consider using the business income of your Airbnb, but it's quite rare. Most lenders, best case scenario, are using the market rents as if it was a long-term tenant in the property. So difficult. Keith has a question. Are lenders' net worth programs usually offered at a higher rate? A lot of major banks now have a net worth program of some sort. Most of them are offering at the same rate, but a couple of the products are offered at a slightly higher interest rate. So it depends on the lender, but there are a couple of net worth programs that are offered at their best rates. Or the lenders that do have, especially the major banks, the interest rate would only be about 0.25% higher underneath the net worth program. So not a huge difference or change. And Penny mentioned, like, the presentation, the explanation of the bond market money supply. It's good to see you, Penny. It's been a long time. Good to see you. Let's see here. Just checking to see if there's any other questions. Oh, there's one in the Q&A. Oh, it just said good presentation. Thanks, AJ. Quick question from Mary. So if you have lots of room in revolving portions and the variable is going up, what is the risk of using the revolving portion to pay off the mortgage and pay only interest? Like, where could you end up? Well, effectively, by doing that, Mary, if you're using the line of credit to just pay your mortgage payments every month, you're effectively creating a reverse mortgage type of situation. You're paying your mortgage, but then you're going up on the line of credit by both the interest and principal amount, and you've only paid down the principal amount. So it's almost like it's exactly a reverse mortgage situation. These types of situations are only really good to use for short periods of time. So if you're really in a bind and you can't afford your mortgage payments, it's always better to just ride it out and hold out. And for reasons that we mentioned now in the FAQ, we do think that the real estate values over the next couple of years will likely rise again. And it's important for you to just be able to hang on and hold on to your real estate. And then a quick question: what's your thought on using a line of credit to fund the mortgage payment? So yeah, I explained that, and I just think that you can do that. It's just not a great long-term solution. It's a decent short-term solution, but not a great long-term solution. Thanks, Michelle. You like this jacket? I do too. I think they said you're not supposed to wear these types of things in on TV because the colors get all funky on television, but not in Zoom. I think it looks fantastic in Zoom. I'm not sure about what you guys think, but I think it looks fantastic. Awesome. Okay, I think I've answered all the questions. Obviously, if anybody has any questions afterwards, then yeah, meet the tailor. I'll definitely hook you up because my tailor is a hustler. She calls me all the time wanting to sell me more suits. So thanks so much for coming out. I hope you guys learned something today. If you have any other questions, email us at info@greenmortgageteam.ca, and hope to see you all soon. Thanks. Bye.